All right, today started off really, really grim. In fact, today had a lot of, looked a lot like the week in January 2022. It was almost looking exactly the same. I'll show you. I'll show you a lot of the similarities we had. I mean, I've told you before that there's a lot of similarities between the end of 2021 and what we've seen at the end of 2024 going into a new year. We talked about that quite a bit, to the point where, again, it looked like this was a carbon copy picture of January 2022 until today's close, right? We rallied. So on Wednesday we rallied and we failed, and we ended up coming back down. Tuesday we failed and came back down. But today we didn't fail. We held up, and we actually had a pretty decent close today, closing near the high of the day, long lower shadow. So what started off as a really down day ended up pretty darn positive. Now, it didn't, we're not out of the woods. We're not bouncing up. The low is not necessarily in. We'll talk about kind of what we need to see for that to happen. And we'll talk about why that might be unlikely to happen this next week, and why next week is so important for us. We'll break all that down. We'll talk about the breadth. We'll talk about the sector rotation. Those are all very, very important to our expectations going forward. We'll break all that down. Taking a look at big moves in the dollar this week. In fact, one of its biggest moves that we've seen in the last 20 years came this week. We'll talk about the implications of that, especially with the current correlation the dollar has with the S&P. And then we'll take a look at our trade ideas in a company that's had an outstanding 2024 going into the beginning of the year. Just unbelievably parabolic move that might have been broken this week. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, March the 7th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook Live video. Click on this icon here. It takes you to our Market Outlook Live. You can take a look at how we manage all the old trades we've done in old videos. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do this day in, day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicators. You can see we finished today on a really, really good note. Considering things look pretty grim at the lows of the day today, early this morning. But by the end of the day, good close here. This is kind of the close that we were hoping to get over here on, what would that be, on Tuesday? A little bit of a hammer pattern that we ultimately didn't get. We came back down late in the day. We did not come back down late in the day this go around. So that's a really good long lower shadow, a little bit of a hammer. It's not the best hammer because it's a little bit too big of a body, but still, and not enough of a lower shadow, but still the same idea, right? A long lower shadow. We close a lot closer to the high of the day, which makes it a lot easier to avoid a new low on Monday. So good move. And the near-term line rally did not cross 40 yet, so it's still in bearish territory, but the momentum line is up. So we're set up, like if this were to follow suit and jump and continue this move. Sorry, my camera's kind of freaking out on me here. Sorry, let's try this one more time. If the momentum line were to follow, like continue to jump higher into the reversal zone tomorrow, and the near-term line were to cross 40 as well as maybe 50 and or 60, then now we've got a good rebound, right? We have the good opportunity for a rebound off of this low. Now, granted, so we've had 2 days like this before. We weren't as bullish on Wednesday, but we had a similar type pattern. And then over here last Friday, we had a similar type pattern. So this is the second Friday in a row. The momentum line's not as high. The near-term line's slightly lower. The intermediate line now is much lower, right? Before, on Friday, it was almost into bearish territory. Now it's actually in the reversal, pretty clearly in the reversal zone. So no cross, like the cross doesn't matter now. Across to the near-term line up above it because it's in the reversal zone like it did over there. So it's a little different now. It's going to take more, move to get going than it did last Friday. Last Friday, we were kind of set up potentially to kind of avoid all of this, and we didn't, right? Monday, obviously, we reversed back to the downside. And so we'll see how we're still way below the 2.5% mark. We kind of need to get back above that level. You can kind of see, like, when we do get below it, once you get back up above that level, we're good, right? We're feeling good about ending the intermediate run we're on. You can see even with a little bit of a pullback right there, we didn't get back below it. So, I mean, for to kind of look at a few other examples, back over here, you can see we never really did get below it in the first leg lower. We got back below it in the second. We ended up getting up to the moving average, getting a bear tag, and then bouncing down, got back below it again, and then we rebounded, and we were fine. We got that bear tag there. You can see over here when we got back above the 2.5% mark, we were fine from that point. Same thing over here. Going back to some of these correction lows, we never did get back above zero. We got the bear tag there. Got the bear tag here. Had a brief intermediate rally to the upside before falling a little bit. Once we got above 2.5, again we were fine at that point. On this pullback, we never did get below the 2.5% mark. So, but especially when we get below 5%, once we get back above the 2.5% mark, like pretty much like we are now, we're pretty close to 5%. We were at the lows of the day below the 5% mark. We got a good chance of rebounding. So that's kind of the next level to say, okay, I mean, nothing's guaranteed, but it'll increase the odds that we've set the low point here if we can get back above that 2.5% mark there below the 30-day moving average, which obviously is red. We got dark pink shading in a red line. This is clearly bearish from that perspective. Market sentiment's falling still. Taking a look at the NASDAQ 100, you can see, again, we're pretty early here. Let's go to a one-year chart. Back to a 1 year. We have intermediate posture. The near-term line is actually falling, so a little bit less bullish than what the S&P 500 is. We're further below, 5% below your Dow Jones Industrial Average. If you take a look at that, you can see the intermediate line again in the reversal zone. The near-term line has crossed above 40. The momentum line's higher, so that's actually really good, except we prefer the momentum line to be above 80 on this first day. We're crossing above 40 on the near-term line, and we prefer the near-term line to also be crossing above 50 or 60. So it's a bullish day from that perspective, but it doesn't necessarily increase the odds that we are done now, right? That's just a little. I mean, again, we had this before. We had a jump up above 40 right there. That would have been last Friday. Same thing. We were above 40. The momentum line was way in the reversal zone, and it wasn't enough, right? We didn't cross another line besides just 40 on that move. We ended up at 48. And we're actually lower on both lines this go around. So if we failed last Friday, then we're probably likely to fail again from that perspective. And then finally, your Russell 2000. Again, it did cross a 40. Momentum line's above it, but again, very weak cross, not crossing another line. Momentum line's very weak. It's not even in bullish territory. So not the best pattern there, even though we do have a long lower shadow. Again, on all of these, we have long lower shadows. We are still way below the moving average at the lowest levels of the past year. Remember, in the Russell 2000, not in a pullback, it's in a correction, right? We had the pullback, the full pullback bounce failed, and now we're to new lower lows. We're in a correction on the Russell 2000. So this is a much bigger deal, which is why I think we're not necessarily done on the S&P. It is the end of the week, so let's take a look at the weekly market forecast on the S&P 500. Let's see here. The weekly. Let's go to a weekly chart. And you can see here on the weekly chart, again, we kind of have a bull tag. Now, the only reason why it's not a bull tag is because the intermediate line is not below the 80th percentile, right? That's why it's cross market sentiment, but it's not below the 80th percentile. Again, we saw that over here as well. We didn't cross below the moving average over here. If you go back to 2021, we got a bull tag because we did get the light pink shading on that day, and the yellow line, the intermediate line, was a little bit lower on that week, that we crossed below. So similar, just not getting the bull tag again because we don't have light pink shading. That's the only reason. The short-term sentiment's a lot less bearish than it was at the lows of the day. So that late rally helped get our sentiment lines up to a much higher level. That's a good sign. We are pretty decently below, 1.63% below. Again, on days that we get bull tags, like for example, this one right here, we were 2% below. So we were actually a little bit lower than that, and that one ultimately ended up bouncing. And then when we had this one over here, we were 2.8% below. So again, because of the nice rally up to the upside, we avoided being down. We were close to that. I think we're at 2.7% earlier today. So we avoided that. We're only down 1.63. So that's a good sign, considering, again, like you look at the NASDAQ 100, right? It is, and like we do have, again, we really close to a bear tag because of we weren't there at the 80th percentile. The short-term sentiment's not as bad as it could be, right? The momentum line's not too oversold. The near-term line's not in the reversal zone. But you look at the Russell 2000, which, remember, it is in correction mode. The intermediate line on the weekly chart is actually in the lower half of the chart here. And you can see we do have a bull tag. We have, we got that last week. We definitely went lower than that this week. We have dark pink shading and a red line now on the Russell 2000. Again, that happened early in 2021 or late in 2021 before the S&P turned into a correction on its first pullback move in early 2022. So by the time the S&P started to show weakness, the Russell was in a correction mode, and we're seeing the same thing happen again. At least as of right now, we're seeing the same thing happen again on the Russell this go around. Right? We haven't had dark pink shading and a red line since the fall of 2023, when again we were in correction mode here on the Russell, and the S&P was in a quasi correction. It had a correction inside of the pullback range. We talked about that quite a bit. All right, now let's take a look at this other weekly chart, which is our Hakunashi candle. Obviously, we have a bearish Hakunashi candle. It's a lower low. We did not close below last week's low, so that's a positive sign. That's the low point was 58.37. The lows, obviously, we were at 56.66 earlier today. We closed up almost 200 points off of that low today, so we ended up with a much better close on the Hakunashi close. Remember, the Hakunashi close is an average of 4 values: the open, high, low, and close of the regular candle. But still, it's a pretty decent sized body, as you can see. The PPO has fallen below the 5% mark, which when you're above it, that's a pretty key sign to fall below. We got the red arrow last week, so we're below the 10-week moving average. It's falling. So we really kind of need a candle like this next week. A green arrow, get back above the 10-week, which is only 59.57. I mean, we went 200 points today, another 200 points next week, and we got the green arrow, right? So if we can get a green arrow, get a little bit of a, even if it's something like this, then, we can feel good about this being over as quickly as it started. The last weekly chart we'd like to look at is the whole moving average. Again, a little bit of a concern here too, because the parabolic SAR flipped to the upside. We are below the 200-week whole here, so that's a pretty significant change. And the 20-week whole is red. So I mean, those are all, again, that doesn't necessarily mean we have to go into bear market mode, but it's not a good sign, considering that it's you can see some of these other periods. You get, when we cross all these other periods, when we had that, we never crossed below the 200-week whole. When we crossed below the 200-week whole in 2023, right there, we didn't flip the parabolic SAR up, and it was, the parabolic SAR had been above it for weeks and weeks. If I go over here on this week that we crossed below it in 2021, early 2022, which is very similar to the week we're getting right now, that was also a week where the parabolic SAR flipped. We crossed below the 200-week whole, the 20-week whole turned red. We had a brief period right before that. It happened to be a couple months before that. Here was a few weeks before it, but it's very similar. That's why it's a little concerning there that we kind of get that same kind of pattern that we saw in early 2022. Let's take a look at the 3 green arrow chart. Obviously, we're getting 3 red arrows all across the board, but if you take a look again at the weekly version of this, we're getting 3 red arrows, right? Again, that's now, we can bounce off of this. Now, I mean, the last time we had 3 red arrows, again, at the end of that 2023 pullback, we had 3 red arrows, and we bounced up like crazy. But the market sentiment line was in bearish levels. I mean, we had a deep pullback there. This isn't a deep pullback. Our zigzag chart is barely at 6%. It got to, what did it ultimately get up to? 6.6%. So I mean, that's a garden variety pullback. That's nothing special at all. So when you look at it from that perspective, it's kind of similar to what we saw over here when we were the end that week of January 17th. We got 3 red arrows, and we weren't necessarily we had some pretty decent volume, wasn't too big. So we really need to not follow through on this. Now here we had 1 week to the downside, we bounced back above it. Great. Here we had 2 weeks, we never closed back above it. We're not as far below the moving average now as we were there. So we don't have as much room to to have bullish weeks and not bounce above it. So if we're going to bounce up like we did right here, we're going to get back above the moving average pretty quick and probably get back to 3 greens. The problem though with that idea, we're going to get back to 1 green on the moving average, right? But if you take a look at where the MACD is, that MACD pattern, so let's go 4.28, which is where we're at right now. 4.28 right there. You can see this is some pretty, this is more momentum than we saw during any of this period. It's similar to the momentum again at the end of that run in 2023, and similar to the momentum that we had again, and in fact more bearish momentum than we had that week of January 17th, 2022. So that's a little bit. I mean, that's a little too much momentum right there on the weekly basis. Taking a look at the 2-line version of this chart, again we are below moving averages, sitting on the 200-day. So of course we're going to get a little bit of a stop here. The 200-day moving average is here. So and if you look, the S&P never did really close below that 200-day moving average. So that's a good sign. That's a good sign. If you look at, here's the not so good sign, right? On the weekly chart, we closed below the 17 and the 30-week moving average at the same time. All these other times we closed below the 17, we bounce right back up. Over here, we closed below the 17, and then we close below the 30 later, and then the 50, and we bounce right back up immediately. Well, when the last time we closed below the 17 and the 30 week after a period of long extended period of bullishness, but that was it right there, January 17th, 2022, and of course that ended up being the correction, the start of a correction there. So that's a little bit of a concern as well, especially considering that we're way up. If I look at this chart here. Here, let me bring up this chart, and I'll bring up that same period of January the 17th. So let's go out to, it's going to be right here actually. We'll go out to, it was 2022, and it was this week. So we'll go to the close of the week, and then we'll go a week before that. So January of 2021, and we'll go to the 23rd. So a full year, right, of that. Well, sorry. All right, I need it to be a 5-year pattern. Dang it. So let's try this again. So 17. So there's a 5-year chart on a weekly chart. Make sure it's a weekly chart. Okay, so that's what it looked like then, right? It looks very similar, just a lot more bullish then versus now. Here's now, there's then, right? Now, and then. I mean, it's again uncanny. Like, again, look at the PPO at 0.5 then. Now it's at 0.35 now, right? We crossed below moving averages. We're way above the value. In fact, the 200 week is above the value. I mean, we were insanely bullish there, the 200 week. The 200 week is not above the value area, but it's close, and it's above the point of control. And we're above the value area here. So we're not as insanely bullish now as we were then, as we were here, but you can see the pattern looks almost exactly the same there. You can see how these kind of patterns rhyme with each other. All right, so let's take a look now at some of these other oscillators. So we'll look at the DMI here. Again, we're above, almost above 30. We're actually below 10 on the negative indicator, so we have an arrow down there. That's an insane drop. The ADX is now almost above 25. Let's take a look at the weekly version of this, and you can see we're above 25 on the weekly, below 20 on the 20. We haven't had that since the very end of that 20. In fact, that last week, this was the last week of that big deep pullback, quasi correction, was the only time we were above 25 and below 20. The time before that, where we crossed above 25 and below 20 at the same time, was pretty much right there, if not the next week. I got all the way up above 30 on the negative and below, and at 15 on the positive. We're at 16 right now. So another sign that we're close. And the ADX was really low and starting to turn up. The ADX is really low and starting to turn up. Right? Much lower than it was actually during the 2023. The ADX was actually above 20 at that last week of the 2023 deep pullback there. Looking at the RSI and the CCI, you can see we're bearish levels on both of these on the daily chart, which is not surprising. But on the weekly chart, we have now ended, like we are below minus 100. In fact, we finished below minus 150 on this weekly CCI. We clearly dropped below 50. Again, we haven't been there since 2023 was the last time we crossed below 50, and we crossed below minus 100 on there. And again, a lot of differences between now and then. The time before that we crossed below both these levels, from being above 50 to being below and below minus 100 was that same week. We closed at 44, 46 this time on the week of January 17th of 2022. We closed at minus 185. We're at minus 165 this time. So not as bearish now as we were then, but again, this is the last time we've had these kind of patterns before. Looking at the Ichimoku cloud, again, remember a pullback, we get below the cloud, we immediately come back up. Boom, boom, boom. Corrections, we get below the cloud, we don't come back up, right? And so especially if we get to mature levels here on this trend strength, which we're close, and especially if we get to the pink shading and we're not back above the cloud already by then, right? That's the concern. If we end up failing and then coming back down the lower lows by the time we get to there, then we're in trouble, right? We're in trouble at that point. That's the daily. Of course, the weekly Hakinyashi, we're floating with the blue line, which is the midpoint of the it would be the 26-week range, right? This would be, so that's a 6-month range. We're almost closing below the midpoint. We were below the midpoint of that range. And again, we haven't been below the midpoint of that range since the very end of that 2023 run. And again, we closed below it there. I mean, the only difference between now and that week of January 17th, I mean, the only difference is we came off the lows today. I mean, that's it. We had a cluster on the market forecast at the lows of the day today. If you go back to that week, January 17th of 2022, you go back to that week over here, which was right here. There's this January 17th, the end of the week. We had a cluster on that day. We closed at the lows. So the only difference between now and then is we didn't close at the lows like we did then. And we didn't get a cluster. As a result, we didn't get a cluster. But we did have a cluster at that point. So, a lot of similarities. And again, you can see because of that, we didn't close below the 26-week range like we did over there. And of course, your rate of change over the past 26 weeks, which is a 6-month rate of change, is still negative. And we actually still have a trend. You can see on that week of the 17th, we also still had a trend. The next week, it was done. And when it was done, we were done, right? We were done with that long-term bullish move. And we had that similar pattern over here when it looked like we were going to have a correction here. And we never did get below the 200-week moving average, never got below the cloud. See over here, it took us a while to get to the cloud. We eventually got below the cloud, and we had the same issue that we do on the daily chart. By the time it turned pink, we were still below it, right? That generally doesn't happen because even if you look at the prior corrections, like in COVID, by the time it turned pink, we were well above it. 2018, by the time it turned pink, we were, again, this is 26 weeks forward now, 6 months later, we were already above it. You should be back up to new highs within 6 months. And you can see the same thing in 15 and 16. By the time it turned pink, we were well above it. 2011, by the time it turned pink, from this correction, we were above it. So we should be back above it by the time it hasn't even turned pink yet. So that, that takes a while for that to happen. So we still have a mature trend. So we're still like in infancy stages. But next week, it will be very important to see whether or not we end the trend, right? And it breaks down to zero there. Really, really important week next week. If I take a look at the intraday range. Oh, no, we didn't look at the Bollinger Bands. Let's take one more quick look at the Bollinger Bands here. Again, we are in the lowest quartile. Despite the rally, we're still in the lowest quartile. And despite the rally, we're barely above the Keltner channel, the lower Keltner channel. Like, it took that much of a rally to get above the lower Keltner channel. We were way more above the lower Keltner channel on Wednesday and last Friday, and both of those failed. So I wouldn't necessarily say we're out of the woods yet here. And if I look at that momentum and think, that's some pretty deep momentum. It's the lowest momentum. Well, it's about on pace with that August 5th for the lowest momentum that we've had of the past year. But if I go back to the past 5 years, it's not the lowest momentum. You can see it actually went lower during the correction drop, and obviously any correction drop, it can go lower than this. So we're hardly extreme if this is indeed going to turn. Remember, a correction is not just a 10% pullback, right? Because a 10% pullback actually, like it prompts at that point a failed pullback bounce, right, of 5% or more. That doesn't get back above 30, 50-day moving averages, and then we go to lower lows after the 10% decline. So a lot of times you'll hear the financial media say, oh, it's 10% down, we're in a correction. Nope, that's not how it works, right? That's the pullback stage of a correction. The failed pullback bounce comes after, and then the correction starts when we go to lower lows and we get below it. The correction is a real definition of a correction. Is beyond the high school level financial media definition that they give, that everyone gives, is a sustained move below the 200-day moving average. That is a real definition of a correction. And obviously, we're sitting on the 200-day, which is what a pullbacks do. Pullbacks get you towards the 200, below the 50, and then towards the 200. If not coming all the way to it, maybe even getting a little bit below it. See, there it got a little bit below it. But that's a pullback, right? That's what a pullback is. There's your failed pullback balance at the 30, and then we went to lower lows, and now we have our sustained move below the 200-day. That actually went on for months. That was a very, very long and deep correction. Remember, it was a bear market inside. It was a bear market inside a correction range, right? So very weak bear market, very strong correction. Like it was not a bear market. It was a correction. Because we never got below the 200-week moving average, which is what a bear market is. A sustained drop below the 200-week moving average is what a correction is. And you can see here, when I go to the weekly version of this, in 2022, we touched the 200-week and we never got below it. But if you want to see what a real bear market is, a sustained drop below the 200-week moving average, that's a bear market, right? You can see that right there. All right, let's take a look at the intraday range now. And you can see we did get a higher high and a higher low. We finished above yesterday's low. We did not finish above last week's low. So we're going to get a lower high and a lower low, finishing right around the middle of the week's range. So we'll see. We're still below the value area the past 4 weeks, which is a pretty wide area here. We did get a new low, so we're still 6 days away from the red line crossing below 70. We're still about 6 or 7 days away from the green line hitting 0. That's when we can feel good about a low point being formed, and we don't have that yet. Again, if I want to go see what it looks like on that 2018 time frame, 2021 time frame, sorry. So right over here, when I got that low point, that first pullback, you can see by the time we got below 70, and we never, on the failed bounce, we never got a new 4-week high point, because it doesn't happen on the failed bounces. And we got a new lower low, we got new lows here. Eventually we got the green line. Again, that was a failure that ultimately led to some more weakness there. So if this is indeed a correction, we won't get the green line to bounce back up. We'll get the red line down, and then it will resurge once we go to new lows there. If we go to new lows. If I take a look at today's range, you saw the range, and the volumes are up high again. They're still rising. The averages are still rising. We're above the 1.5% mark, which is not good, and we're staying there. Right. Last time over here we crossed above 1.5%. We were already bouncing. Right. We started to bounce up pretty quickly. That's not necessarily happening yet, and the VIX is still elevated. It's not extreme, which is also the concern. The VIX hasn't spiked. It's above 20, but it didn't get up to the high 20s. It didn't get up to 30. Right. It got up above 100%, but it's not up to. It got up above 105% even. So it got up to pretty decent levels, and the VVIX is still above 110. So we are still susceptible for an actual VIX spike, a big, strong move on the VIX. Again, if I take a look, just to kind of give you an idea, like the VIX here, we've had some good up days in the VIX. Here we go. We've had some good up days in the VIX since this whole thing started back on February 20th. We peaked over here on February the 20th, 19th. So we started this on February the 20th. We've had some pretty decent moves, but you notice no spike, right? Like we had there, no spike like we had here in August. If I were to go all the way back to, again, 2021, excuse me, You can see we were up in the 20% levels there at the beginning, and we had a huge spike there on the day after Thanksgiving. We haven't had any of that here. If I take a look at a weekly version of this, it is one of the stronger weeks of volatility, but we just had a bigger week in volatility 2 weeks ago, right? So this is hardly a big week of volatility. This week, that's the week of January 17th, right? The week that the pullback got down to correction levels, and the VIX spiked big time. It spiked up 50%. We only jumped up 19%. We still haven't got a big spike in volatility yet. This is pretty subdued, relatively speaking. This week's volatility is pretty subdued, but the VVIX is still, until that VVIX drops back below 100, especially below 110, but below 100, we're still going to be susceptible to that spike and a jump, as you can see, up above the 200-day moving average, up to a much higher level than where we're at. Again, if I were to change to see how far above the 200-day average value we are for a volatility index. If I were to zoom this out again so we can see what that correction looked like in 2022. So there it is right there. We are, if I were to move this line to how high it got there, remember with that pretty decent week of bearishness, right? A big week of volatility we had, like this is where we're at now. This is how far above the 200-day moving average we are now. Like all these other spikes, we got a lot higher. In fact, this is kind of on par with some of these levels we saw in 2024. Like it's higher than 2023 or April 24. It's higher than 2023, only because the 200 days rising now instead of falling. But like this has not been a big jump in volatility, not even close to the type of jump that we saw yet. So I don't know if necessarily this has been such an exhaustive move. If we bounce up here next week, then it's just a typical pullback. But we might still have an exhaustion type decline left in us if we are indeed going to turn into a correction. Which again, as I mentioned, there's a lot of signs that would suggest that we are on that path. So we'll cross our fingers that we kind of bounce up this next week and we avoid all of this and just end up with only a 6% decline, and we can rally ourselves up with some bullish patterns next week up to a new green tag of double-digit returns over the next few months. All right, now let's break down what's driving this price action today and what happened here over the course of the week. So we'll start off with today first, and you can see international stocks still doing very well because of the weakness in the dollar. Yields are up again today. Yields started off down but ended up today strong. And remember, stocks and yields both went up. So stocks were down, bonds were up, and then stocks rallied and bond yields rallied too. So we're kind of returning back to that normal correlation that we have between stocks and bonds, normal negative correlation, a deflationary environment correlation, right? We've been in this inflationary environment since really 2021, and so they've been moving together. Stocks and bonds move together, and that's atypical for the last few decades, where yields have been gradually falling since their highs in the early 80s. If I were to zoom out a little bit and just look at the whole week that was, then you can see stocks were, this is one reason why we rallied so much. At one point in time, the Qs were down 5% for the week, and IWM was down almost 6% for the week. They ended up down 3 and 4% on IWM, so big move up off those lows. But look at that weakness in the dollar. This is probably one of the biggest down weeks that we've had in the dollar in a very, very long time. Let's look at the price moves here, and we'll take a look at the dollar index. And let's go to a weekly. Look at that. We were down all 5 days this week. It's been a while since we had a 5-day losing streak. But let's look at the weekly return, and you can see we were down 3.4%. So the last time that we were down over 3% was the week of, at the end of 2022, November 2022, when we kind of ended the pullback, the correction, right? We started to bounce up higher. Before that, it was during COVID, March of 2020. Obviously, we all know what happened there. Big drop there during COVID. And that's it. The last 10 years, there's only been 3 weeks that we've had 3% or more decline in the dollar. If I were to zoom out a little bit more to the last 20 weeks, You can see before that it was over here in the 2008, the very end, and the worst of the great financial crisis. We dropped in December of '08, we dropped in March of '09, right when we were bottoming out in the stock market, and then May of '09. As you can see, that was it. Like those, it's been now 6 times that we've closed the week below 3%. 3 of them during the end of the great financial crisis, 1 during COVID, and then over here, and like I said, the end of the correction, November 2022, and then now, and then what we've seen here. I mean, that's a significant move. This is what it looks like on the chart. If I look at the weekly chart here for the dollar index, you can see this is a pretty transformative move here, because we broke we had jumped back above the 8-day last week on Friday, but we broke through all these moving averages, right? The 8, the 17, the 30, the 50, which are pretty much sitting right on top of each other, and looks like we're headed towards the 200-week moving average. Again, the last time we had a sustained drop below the 200-week moving average was back here coming off of COVID, right? When we had a really good bullish move there. 2017 was also a bullish move. So you think, oh, well, this might be a time that the dollar actually ends up, that we might have a bullish pattern in the stock market. Let's look at the correlation here. And I'm going to zoom out on the correlation. Pull up the dollar index here. We'll take a look at it on a weekly basis. So let's look at it on a weekly chart. Again, this is with the S&P 500. You can see right now it's a positive correlation because they've both been dropping. But it's generally a negative correlation, as you can see here. For the most part, it's a negative correlation over a 10-week period. Let's zoom out to a 6-month correlation, since we're looking at a long term. And again, generally speaking, they are negatively correlated. Generally speaking, there are times where it's positive. In this case, both going up, both going up, both going up. As you can saw in 2008, the dollar started to drop. The dollar started to rally while the stock market was dropping during its bear market, right? And before that, we had a positive correlation as they were both going down at the beginning of the correction of the bear market. During the correction phase of the S&P 500, the correlation turned pretty strongly positive because they were both going down. The dollar was already kind of in a bearish mode, but everything kind of fell. And we had a pretty big drop there in 2008 as well on a weekly basis. You can see this week right there, pretty big drop. But here we go again with a pretty negative correlation, positive correlation between the dollar and stocks, and they're both right now moving in the wrong direction. And if you look at their daily correlation here, and let's go to a 3-month correlation on the daily chart, it's turning positive, right? We've been gradually moving higher. It's turning positive, and we zoom into a little bit to let's go to a 4-week correlation rather than the normal 10-week, and you can see pretty strongly positive correlation. Like they're moving together. That's not necessarily the pattern that we want to see. On the other hand, if you take a look at the 10-year yield, because remember it actually ended up the day up, right? Ended up with a strong move back up to the upside above the 8-day moving average, and MACD and stochastics are turning up. So you have green arrows on the MACD and stochastics. Obviously, you wouldn't have the third green arrow yet, but you can see like even yields are starting to move their way up to the upside, though still in a relatively bearish trend. And if you look at it on a weekly basis, you can see we had broken the 17-week. We got that move down on the yields last week, right? A little bit of a bullish bounce this week so far, but we had that move down on yields last week, and we had this discussion in one of our Q&A sessions. Yields have been in a kind of a bullish, like we haven't been above the 200-month moving average ever, right? I mean, like it's been, since the 80s, since the peak in the 80s, it's been a gradual move below the 200-month moving average. This doesn't have the data that goes all the way back there, but we finally broke up above that during the rate hike cycle. We didn't get above that during this cycle here. We didn't get above it, during the rally here in 2012, 2013. We didn't get above any of those times, but we did now. We're above it. And I don't know, like if we were to start to drop, I don't think necessarily like if the Fed drops, even if the Fed drops rates down to 0%, I don't know if the 10-year yield falls back below 2.5. That would give us a 200 basis point yield spread. And if you notice, if the Fed drops it to 0%, right, and we drop down to 2% or 2.5%, if you notice here, a 2.5% yield spread, like that's, where is that? Oh, up here. So you can see that's kind of normal for it to get up to, if we were to move up higher. So, yeah, that's an interesting pattern here. Here you go. Here's the 10-year yield going back to the 80. So last time we were above, we had dropped below the 200-month moving average in 86 when we were coming off of that 84 peak. We had fallen below 10%, and we never got above the 200-month moving average until just recently. So we are in a different environment, right? A much different environment from a yield, like a regime perspective, than we have been in on yield. So even if we do, even if we go into recession and yields start to falter, I don't think necessarily they'll get down there. And I think as a result, our yield spread will end up getting up to that 250 basis points. My breadth, the other issue about this current pullback is breadth has not been extreme either, right? We talked about how volatility really hasn't been too extreme. Well, breadth hasn't been extreme either. Like we're at minus 31. We've only spent a few days below the minus 35 mark, but nothing too major. When you look at the number of stocks above or below their 50-day moving average, right? Like that hasn't dropped very far. It hasn't gotten below the 200. This is the number. This is actually the breadth for us here. Let's look at the number of stocks below their 50-day moving average. And you can see we're above. We never did get below 200. I mean, we got below 200 on this pullback. We haven't gotten below 200 on this one yet. The number of stocks above the 200-day moving average actually jumped back above 250, though again it's looking pretty ominous there. But that's not too extreme yet. The number of lows has pulled way back below their average. The net new highs and new lows has come way back up here to this minus 200. So we had a big dip, but it didn't really stay sustained. So I don't think necessarily that we've had this big thrust move, right? This move that we're really concerned about. The move I am a little bit concerned about is XLK. XLK has been very oversold. But this is the most important sector in the market because it's got the biggest companies in the S&P 500. It's the leader, right? This sector can't break down and everything else will be fine, right? This is the leader. It's got to keep going up. So if I look at XLK here, and I look at the weekly chart, right, you can see we're below the 200-day, which means that we're in, this is definitely a deep pullback mode for XLK. In fact, if you look at the zigzag for this, remember we saw in the S&P we looked for 5% target. Well, we've had 5% and failed bounces, and now we're down 11%. So XLK is down 11% off of that. That's a pretty decent level. And then when you look at its, where it's at relative to its moving averages. Here, let's see here. Let's go to 20 years on a weekly chart. You can see it is below its 50-week moving average, right? It hasn't been, the times it's broken below the 30, it's bounced right back up. Well, we broke below the 30 last week. We didn't bounce back up. In fact, we're below the 50 now. And again, the last time we broke below the 50 was back over here in February 2022 when we started to break down. We broke below the 30 and we started to break down. You can see the MACD has gone negative. Again, last time it went negative was briefly there in 2023 at the very end of that run. The MACD was negative. We're obviously a lot more negative than we are now. We're in the lowest level. If you look at the weekly RSI and CCI on technology, obviously the daily charts are bearish, but if you look at the weekly charts, we're below minus 200, which is its lowest level in the last 5 years. And you go out the last 10 years, COVID, we were down below. We never did get this low in 2022. And you can kind of see some other instances. Very, very bearish. The lowest RSI we've seen in some time. So I'm a little worried about the breakdown that we're seeing in technology and the rotation that we're getting away here from. Let me bring up the sector ETFs here. The rotation we're getting away from technology. This is a weekly chart and it's in the lagging category. And all these safety trades, as well as cyclical areas that are all negatively correlated. Their ratio charts with the S&P 500 are all negatively correlated for the most part with the S&P. So when they outperform, the S&P typically doesn't go up. And they're all now moving very rapidly into the outperforming, into the leading category, that's on the weekly, obviously, which means the daily they are all in the leading. In fact, the only one, XLY and XLK, are the only ones in the lagging category right now. So not the rotation that we want to see here. All right, that brings us to our trade idea of the day. Let's take a look at Walmart. Walmart really got hit with the Costco earnings news. Walmart finally started after like multiple days of dark pink shading. It's got the red line now to go with it. It's down 7%. This is the lowest it's been below its moving average in the last year. And short-term sentiment's bearish. The near-term line down into the reversal zone. The oversold momentum line there. Market sentiment's down. So it looks like most everything else, but it looks like it's just kind of barely starting its decline. It's chart very high PPO. It's in the 83rd percentile still, so it's still very high, 13%. So the gap between the two lines is still very large. I mean, look at the year Walmart had last year. This is a tremendous year in 2024, and for that matter, a pretty decent year in 2023 as well. But we've hit this 100 level, and it's like this has kind of been like we've got the transition. We got a green arrow last week, but back to a red arrow this week. If you look at the 3 green arrow chart for Walmart, obviously we are in a 3 red arrow environment after a brief green arrow there on the moving average and stochastics. We're back to moving lower. The momentum is picking up again to the downside. If you look at the 2-line version of this chart, we're breaking below moving averages. So we're below the 50. The 8 and 17 have crossed below the 30. You can see we're moving into the gap between the 50 and the 200 are moving into a pretty decent gap of volume there as well. If we start looking at some of these other oscillators, you'll see that again, we're above 30 on the negative indicator, or below 20 on the positive. The ADX is already almost back above 25. The RSI and the CCI are at bearish levels. We dropped below 40 here, dropped below minus 100. If you look at the weekly CCI, we're below 0, so this is clear. We were so bullish on the R. I mean, like I said, 2024 was a great year. I mean, the RSI on the weekly chart was above 70 for most of the year. That's insane. As you can see, that is absolutely insane. This was a tremendous year. Again, we kind of had a little good year at the beginning of 18, end of 2017, but this even makes that look like that wasn't that big of a move, right? This is a tremendous move. But now we're back below 0. We're not above 60 anymore. We're back below 0 on the CCI. So things are definitely changing. If you look at the Ichimoku cloud for Walmart, you can see again we are into the cloud here. The rate of change has gone through the green lines below, so we're going to get a pink shading on the cloud where we had a bullish trend, but it's gone, and we're flirting now with a weak bearish trend here. Just like that, if you look at the Bollinger Bands and the Keltner channels, the bandwidth is tremendously high, but we are in the lowest quartile and strong momentum to the downside. We're below the lower Keltner channel, so definitely looking to the downside here. So what I decided to do was to sell a long put vertical spread, sell the low 20 delta at 85, buy the 87.5. This is what it looks like here. Maximum gain is in the 1 standard deviation range. I get about a 3 to 3.5 to 1 reward to risk ratio. It's a pretty good move to the downside there. So I like the setup for a long vertical spread to see if we can fill in the rest of that gap down again to 1 standard deviation move is down to 83. So we're looking for it to get down towards that 85 level and see if it does that. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.